Oracle stock has worst week since 2001. Bust as AI financing concerns escalate. That single number resets the AI playbook. The key question is not what happened, but what changes next for operators and users. We will map trigger, incentive shift, and downstream impact before the close. That's 25 years of market data, and in 7 days, the stock fell harder than almost any other megacap in tech. Here's what triggered it, why the timing matters, and what this signals about AI infrastructure spending right now. The immediate trigger was Oracle's quarterly earnings miss combined with forward guidance that disappointed investors betting on AI data center build-out. Specifically, cloud revenue growth slowed, and management signaled that AI infrastructure deals, the deals everyone assumed would carry Oracle through 2025 and 2026, are not pacing as fast as Wall Street expected. That's a shock because Oracle positioned itself as the infrastructure play for generative AI. They own the database layer, the cloud compute layer, and they've been winning enterprise AI contracts at scale. But here's the critical part, this isn't just an Oracle problem. This is a financing reality check on the entire AI infrastructure narrative. Over the past 18 months, the market has priced in a scenario where enterprises and cloud providers would spend unlimited capital on AI chips, data centers, and middleware. NVIDIA rode that narrative to a $3 trillion market cap. Dell, Broadcom, and chip-adjacent names followed. The assumption was simple, AI training and inference require exponentially more compute, so CapEx will accelerate forever. Except Oracle's miss suggests the opposite is happening. Enterprise CIOs are either, A, waiting for clearer ROI signals before scaling spend, B, consolidating their AI infrastructure into fewer vendors instead of spreading budgets across multiple platforms, or, C, realizing that smaller, more efficient models can run on cheaper infrastructure than initially planned. Any of these would crater the infinite CapEx growth thesis. What's instructive here is the market's reaction. Oracle's decline triggered a broader sell-off in software and infrastructure stocks. Investors who were holding a diversified AI play, betting that all the infrastructure vendors would win, suddenly faced a portfolio rebalance. If Oracle, one of the safe bets in enterprise AI infrastructure, can miss guidance this badly, what does that say about Salesforce's AI strategy, or ServiceNow's, or even the broader cloud software complex? The second implication is subtler but more important. This exposes a funding constraint in the AI arms race that nobody was discussing loud enough 3 weeks ago. Train a large language model. Build the data center to serve it. Integrate it into enterprise workflows. The entire stack, from semiconductors to infrastructure to software, costs tens of billions of dollars per year, and the returns are still speculative. OpenAI burns billions per quarter. Anthropic is burning cash. Google, Microsoft, and Meta are all spending capital at historic rates to compete. The question isn't whether the money will flow, it clearly will, but whether it will flow as fast as the market assumed, and whether enterprises will actually pay for the outcomes. Oracle's miss suggests enterprises are answering, not yet. Now, here's where the India angle becomes relevant. Indian IT services firms, TCS, Infosys, Wipro, HCL, have built their entire strategy around being the implementation and integration layer for enterprise AI adoption. They're betting that when corporations deploy generative AI, they'll need skilled engineers to integrate it into legacy systems, retrain workflows, and manage data pipelines. But if enterprises are tightening their AI budgets and consolidating vendors instead of expanding infrastructure, that cascades to consulting spend. Indian service providers could see deals delayed, contract values reduced, or timelines extended. Conversely, if Oracle and other infrastructure vendors slow down, some of that capex might shift from hardware to services, which could create a slight benefit. But the net effect for Indian IT is probably negative in the near term. Delayed deployment means delayed implementation, which means delayed contract wins for service firms. Globally, this Oracle miss is a crucial moment for the AI narrative. For the past 2 years, the story has been, AI is too important to underfund, so companies will spend whatever it takes. Oracle's earnings just said, that's not quite right. Spending is happening, but more selectively, with tighter ROI gates, and slower than Wall Street modeled. What to monitor over the next 3 to 5 days? 1. How do other infrastructure vendors respond when they report earnings? Broadcom, Dell, Nvidia are all on deck. If they beat, Oracle becomes an outlier and the stock might recover. If they also disappoint, you're looking at a structural re-rating of the entire AI capex complex. 2. Guidance revisions. Watch whether any vendor lowers forward guidance for AI infrastructure segments. That's the real signal. 3. Enterprise CIO commentary in earnings calls. Specific language about selective deployment, ROI timeframes, or consolidation is more important than any analyst question. And 4. Treasury rates and financing conditions. If the cost of capital rises further, enterprise budgets tighten even more. Oracle's miss could be the first domino in a longer reset. The deeper story here is that the AI infrastructure build-out is real, but it's being paced by actual enterprise demand and financing constraints, not theoretical compute requirements. That's healthy for markets long-term, because it means the winners will be companies that can prove customer ROI, not just companies with the biggest capex budgets. But it's painful in the short term for anyone holding a pure-play infrastructure bet. This is worth paying attention to. Subscribe to Atlas Signal for daily signal-first analysis on AI, markets, and tech infrastructure. Oracle just had its worst week in 25 years. The stock fell 25% in 5 trading days because management guided lower on AI infrastructure deals. Enterprise customers aren't spending on AI as fast as Wall Street expected. This matters because the entire market has priced in unlimited AI capex growth. If Oracle, one of the safest AI infrastructure bets, is missing guidance, what does that signal about Nvidia, Dell, and Broadcom when they report?